Welcome back. This is your official economic review, where we're telling you now the biggest headlines that you are waking up to this morning. Just before that introduction, let me introduce the panel that is going to join us for the next couple of minutes as we tinker with those headlines. We are joined by Faith ATITI, who is a senior research economist at NCBA Bank. Faith, good morning.
Good morning. Thank you for having me.
Welcome to Metropole Television. We're happy to have you around. We are also joined by RUFAS KAMAU, who's a research and markets analyst at Scope Markets. RUFAS, good morning, sir.
Morning, Simba. How are you?
We're great. We're pushing on. And later on, we'll be joined by MBARIRE, who is the CEO, Retail Trade Association of Kenya. Let's begin on those stories then this morning, shan't we? Meanwhile, analysts at NCBA Bank have projected an economic growth rate of 5.3% for 2021, an upward review from the 3.9% growth rate projected in November last year. During a virtual economic forum by NCBA on Tuesday, the upgrade is on account of recovery in its select sectors that have been earlier affected by the containment measures against COVID-19. According to Raphael Agung, who's the chief economist at NCBA, the bank's previous assessment had underweighted the return of the education sector and its effect on the performance of the transport sector as a driver of GDP. Good. Now let's look at that analysis this morning before we bring in a Faith who's going to take us through the rest of those numbers this morning.
Assumptions that at November had underweighted the significant return of these key sectors of the economy, hence this dramatic upgrade from 3.9% of GDP output to 5.3%. We have an economic recovery strategy that has outlined what will be the key drivers for our growth. Just in summary, we have the implementation of the economic stimulus program. That's at about just north of 23 billion. We think if that is implemented, that will drive growth, so that expenditure point. There is, of course, the continuation or a greater emphasis on fulfilling the big four, starting from universal healthcare, extending the quantum of manufacturing, food security, including affordable housing. The allocation there was quite significant, almost 142 billion. So if that is followed through, including the item as this, we think that will drive growth. More significantly, though, and this has contributed to Kenya's growth in the last 5-8 years, is the investment in critical infrastructure. That's the other third limb to the economic recovery path as we see it. If that is further rolled, I guess there is the phase 2 of the SGR as a potential growth lever there. I think there's 27.2 billion that was allocated and increased of the meter gauge railway as well, all the way to Kisumu. The fourth lever of this growth dynamic as we see it is improvement of our security apparatus. By the way, very huge capital outlay there, almost 295 billion. So in short, what will drive our economic recovery is the implementation of the stimulus program and the implementation of the budget as proposed, which we've been debating since February 15 to date.
Pretty much. That's where we are. Let's look at where we are coming from then. Let's go all the way back to Q3. Where are we coming from? Let's look at that data this morning that we have for you. Even if you could actually just give us that data for the economic growth so we can actually analyze it before we bring in a Faith this morning. Do we have it? Yes, we do. Now, that is, let's begin from there. That is what we are talking about in terms of where the government is actually going to get this money from. That's our share of revenue in 2020-2021. And you'll see that what is driving that revenue is income tax at 45%. You have VAT that at 27%. You have input duty at 8% and excise duty at 16%. Now let's go back and see where we are coming from in terms of a GDP growth, because that's where the conversation point is coming from this morning. Even if you could actually give us that data for our quarterly GDP growth, Q3, and you will see from there that we're coming from -1 1.1%. That's where we are coming from in terms of that data. You can actually see that because we went up to negative 1.1%. We're still waiting for Q4 numbers because despite us having a budget, what we had was a projection of where we were in Q4 and Q1 of 2021 in terms of those growth numbers. Later on, we shall be showing you exactly that allocation for the big four expenditure. I don't know, Yvonne, if you have that data this morning, so we can actually also see it as we start 2021, 2022. If you have it, then you can actually give it to us some time later on. All right, let's bring in Faith. Faith, first question, 5.3%. Earlier on, you were at 3.9%. Is somebody going to ask you the first question? Are you being overly optimistic in that baseline projection?
That's a good question. And certainly, yes, there have been questions of whether we're being overly optimistic.
Yes.
But just to clarify, I think our estimates among one of the most conservative among all the other major institutions that have published their projection.
Yes.
Starting with the World Bank at 7.6%, the IMF upwards of 7%, the government itself is at 6.6%. So I wouldn't say we are overly optimistic, but like you well put it, remember we're coming from a really low base.
Yes.
Yes, from our own in-house models, we think for 2020 we might have contracted by 0.6%, which is still less optimistic, where government is seeing it what 0.6% growth. And so, if you're considering a move, the thing with base effect is when you're coming from a low base, any small move has the ability to sort of look exaggerated. But I guess what we often say is as much as, yes, we're looking at 5.3%, we'd expect that the multiplier effect of this growth, especially on incomes, will be much slower, given just the proportion of it that is as a result of the low base effect.
Yes.
But that said, like my colleague Raphael said in the interview you played earlier, at the point when we did the first estimate, we'd not envisioned a position where we have vaccine coming on board as fast as they did. We were not clear on just the scope of the economic recovery strategy that the government was envisioning at the moment. And therefore, if you reconsider this, if you add this to the initial upside, I mean, we've reopened much faster than we'd expected. We'd anticipated a kind of stop scenario where the government, where we have episodes of flare-ups in infection that has succeeded by some lockdown or acceleration of containment measures, and therefore, the mere fact that we are more open than we'd initially envisioned. The economy has remained open. I guess at that point we also had a lot of fears in that any flare-up will result in some sort of country-wide lockdowns. But the approach the government is taking with very clustered, very targeted lockdown in sections that are hotspot has meant that we still keep activities within other regions fairly ongoing, even as we try and contain flare-ups in areas, and of course the spread of the same to other areas. So as I mentioned, we're seeing a very strong, of course, education. We're basically coming from literally zero from the second quarter of 2021, where we had like a full closure of schools for the 9 months. So that has the potential, like if you're coming from zero and suddenly you're back to where you at, then you're probably looking at more than 30-40% growth in that sector. Yes. But then it doesn't mean we will be going back to where we are in 2019. In fact, for the sector, we think we'll only go back to where we were pre-crisis in 2022. Yes. So yes, we have some return of activities. The numbers might look, the headlines look healthy, but the anecdotes, the undertones are still quite fragile.
Yes. But Faith, just before I bring in RUFAS to also weigh in on that baseline projection that you gave us this morning at 5.3, I mean, I like how the optimistic question that I asked you is that even in between that, what looks to be of note to you is the economic recovery stimulus program that has been awarded 23.1 billion. That's fine, but if you look at development expenditure, again, Faith, that's well anchored within what has been, I would say, historically, the sectors that have been promoting or developing our GDP, development expenditure has been cut again. If you look at exactly the data that we're giving you this morning, again, under development expenditure, which is the question that, well, is it this trickle down from what we would like to say the big four agenda expenditure, which is neither here nor there as well, in terms of how you look at it? Is that where this number starts to meet the tough, that while we have this number, Faith, but then it is just never here nor there, because the growth paths for our economy have historically been known. We have the sectors that have been promoting our GDP. If they are not functioning right now, then where is this number coming from?
Okay, good question. If you look at even the Q3 numbers, you realize a lot of this growth came from the construction sector.
Yes.
And I guess that's why there's a lot of investment in infrastructure because of the multiplier effect. And they tend to, since they are labor intensive, they tend to have a faster effect on employment. And I guess that's what the government is driving at by scaling up those investments in infrastructure. So just to have employment coming back faster. Of course, there's still concerns about the sustainability of the jobs that are created as a result.
Yes.
But I guess the most upside from economic stimulus, as small as it is that most of it is locally centric. It's meant to be driven primarily by local manufacturers, by local labor markets, and therefore the effect, I mean, the money gets faster to businesses and to people's pockets. And what the government is looking to do is to sort of drive some demand from a household perspective. And of course, there's always concerns also about just the much you drive and the implications on general prices, because if you push in a lot again, there's a chance that you could drive up inflation. So it has to be done cautiously. Yes, we would have loved to see a lot more allocation into the economic recovery stimulus. But that said, I think the other programs, including the big four, and I won't discount the much that was allocated. I mean, 142 billion is still quite substantial.
Yes.
It's still meant to drive activities locally. UHC, this is, if that is certainly implemented, of course, you're reducing out-of-pocket spending by households, and that means they have a lot more to spend. The drivers themselves are meant to at least drive activities within the local manufacturing, the contractors, construction activity. So there's still some fair activity. Government spending in itself, public expenditure in itself drives about or accounts about 2.5 percentage points of GDP. So out of that 5.3, about 2.5 might be coming from government.
Yes.
General expenditure is about 25% of GDP. That is substantial. So you can't just discount how much, of course, government is spending, despite how they are funding it. And so from where we sit, we're looking at growth now being primarily driven by the public sector other than the private sector. But of course, the concern is from an employment perspective, from an income perspective, you need a very active private sector. So if that is lagging, if we don't have proper sufficient spillover from the government spending, then we probably might be stuck in a sort of cyclical period of much slower growth. Thing is, after these best effects fall off in 2021, which is driving this high growth, we might have to deal with some reality. So if private sector is not coming back, then we probably our our nakedness might be exposed.
Pretty much. All right, let me bring in Rufus and give a Faith a breather this morning as we get ready to crunch these numbers. Rufus, you hear what Faith is saying, cautiously optimistic, that even as they give us this 5.3%, she's saying, well, government expenditure might even account to 2.5% of that. All right, let's cross over this morning and give you the slides on exactly how the government therefore has spread this money across the priority areas in 2021 and 2022, if that is going to account for this 2.5%. Yvonne, if you can actually give us that those two slides that are going to show us exactly where we are. Yes, economic recovery strategy has been given 23.1 billion, enhanced security for stability, investment and growth 302.1 billion, infrastructure investment to unlock growth 310.7 billion, and enhancing access to quality education 202.9 billion, which was also one of the key areas that NCBA had noted in that baseline projection of 5.3%. Let's continue. Environment management and protection 93.2 billion, equity, poverty reduction and social protection 103.4 billion, ICT 23 billion, transfer to county governments key in that projection 409.8 billion. Well, first, you hear exactly how the government wants to spend now money, and then we have this projection for 5.3%. Let me get your reaction on that as well. We've seen a lot of numbers, and this number from NCBA looks to be what I would like to call a reserve number out of the ones that we have seen. Do you like that number? Let me ask you that question, because we've seen many.
Yes, I really like that number.
Yes.
I've seen some really good potential for growth in terms of economic growth.
Yes.
So we are looking at rising government spending, which is basically building the consumer spending. Since our economic growth is mainly dependent on the government spending is very influential as to how the economy grows.
Yes.
So we have seen some really good numbers, especially in terms of growth in consumer spending, but also we need to consider the other side of the private sector. So for us to achieve this number, that is 5.6, then we need some several factors to lie in line. The very first factor to consider is interest rates. We know that they are at an all-time low of 7%, which is really good for the economy. So what we would really need is for the commercial banks to push this money to the economy and reduce on the amount they're investing back to the government. So on the other hand, there is the issue of stimulus packages. They are really good. They are supporting key or crucial sectors in the economy. So we might see some good growth this year, but for the number 5.6, I believe we still have a challenge. Main reason, we are looking at economic growth. Traditionally, Kenya has been mainly based on agriculture as the leading contributor to our GDP. But now we have the service sector, which has been growing over the past couple of years, and it has been one of the most affected sectors in the economy right now. So if we consider the service sector, we know that we can divide this into two. We have the daytime business and the nighttime business. And we all know that since the beginning of the pandemic, we've had a lot of curfew being extended over and over again. So for businesses that are really dependent on the nightlife, they have had to suffer a lot. So for most of the small SMEs that could not manage to continue doing business during the pandemic, they were actually forced to close down, meaning that there are possibly hundreds of thousands of Kenyans who have lost jobs through the pandemic, and the ones that are still existing right now, if you look at the hotel sector, the transport sector, they are actually struggling to maintain their employees. So it's very important for us to reach optimum employment in order for us to reach this number. So we have to find a way of finding these guys jobs, or find a way of expanding the nightlife business so that they can at least come back to business, create more employment, more production, and hopefully we can grow the economy and reach that number. So currently, my main challenge would be just the number of jobs that have been lost over the pandemic. So if you find a way of fixing these guys, bringing them back to the economy, then we could easily achieve this number. So on the other hand, when you look at government spending, I I feel like it's being weighed down by the interest payments. So if you look at the past couple of years, the interest payments on our debts keep on increasing. So we need to find a way on working around that. On the other hand, the budget is really good. I saw some really good numbers, especially in healthcare and also the food production. So I believe we are in the right trajectory.
Faith, clear for us this conversation this morning, therefore. I mean, the government is sort of on a higher end when it comes to their projection, therefore, which informs their eventual spending. We are telling them, that number has to come back down. So what does it mean in terms of government expenditure? Should have they spent more? Should have they spent lower? Make somebody watching you this morning understand what this mismatch means when we have a lower number from what the government projection is, Faith, this morning.
Okay. Yeah, your question is pretty much the cat and horse situation. Sometimes whichever comes faster,
yes.
Because the government, of course, through the spending, they're trying to drive growth to what is estimated to be the country's potential. You're trying to reduce the output gap that we currently are facing.
Yes.
And therefore, and on the other hand, of course, you also have growth that is very key to achieving these sort of expenditure targets, because that has implications for your resources, your revenues, how much you get from people and businesses in terms of taxes. But that said, I think, of course, should we spend more? Should we spend less? Of course, everyone right now is trying to spend more, within, of course, the limits. If you look at other markets, we've seen extreme, unprecedented stimulus packages being thrown around the US, the UK, the developed markets generally.
Yes.
But of course, as much as, yes, we would love to see such scope of spending within our borders, it's limited by just the much space we have. As RUFAS mentioned, we're spending a lot more on interest payments right now. Some mismatches, some imbalances we generated from previously are coming back to hurt our general expenditure plans right now. So the government has to sort of walk a tightrope between just stimulating activity by spending a lot more, but then you have to make sure this keeps your debt within a sustainable path. And so you can't just blow it out just because you want to drive spending or generate employment, because then what that then does, it compromises your position. We'll probably see more sovereign rating downgrades if we had to scale up expenditure in a significant way, unless, of course, you have more good Samaritans or donors or funders coming on board to sort of inject in that much support, which we don't expect. Remember also, as a middle income country, we are not very eligible to a lot of these supports that are rather driven towards low income countries, because
yes.
we considered middle income, lower middle income state, and therefore we might not see as much support. So the government has to sort of balance that. And that means basically jobs might not come back on board as fast as we hope. Certainly the private sector is trying, but there are still significant limitations to that. General demand in the economy is still quite low, which means any business will not be looking to pump in a lot of money in terms of investment. Of course, there's still concerns about how the political landscape turn up. There's a whole lot of uncertainty around the BBI and the implication it has for succession politics into 2022. And therefore, there's got to be a lot of some scale of caution into the year, and that could keep investment somewhat muted. So, like I said, we will pretty much depend on the government to drive growth this year, because if you look at even the sectors we're projecting stronger growth come from, which is education, that is a public service. Construction is being primarily driven by investments, public investments by the government. Big four drivers, as well as just the general infrastructure. Agriculture, probably I tend to disagree with us on this. I think it's been one of the most resilient sectors. Thank God to good weather. And as much as, yes, some small segments, including horticulture, have been hit by, of course, the COVID pandemic, I think it's been fairly resilient by the mere fact it's a defensive sector. It's food, more bulk of it is crop production, which was necessary during this pandemic. And therefore, I would believe we'll probably still see some strong growth still coming from this. But of course, where you're dependent on demand, including WAMBUI's sector, I've just seen her join in, the recovery will be a lot more slower. So yes, we could spend more, but I don't think we have space to actually do that right now.
Pretty much. Faith ATITI, thank you very much for taking your time to speak to us this morning here at the Metropole Television.
Thank you for having me.
Pretty much. We take a short break. Once we come back, we are still with RUFAS. Let's talk about KPLC. They've been ordered to reveal the names of the firms behind the PPAs that they have signed for acquisition of electricity. Is that where the performance for KPLC has been hitting them? Once we come back here on a Business AM.